an extra $20,000 from the wrong account in retirement, and the IRS can tax it like you earned $30,000. Your Medicare premiums can jump too, and it can keep costing you for years. The account you pull from first matters as much as how much you save. By the end of this video, you'll know the 3 tax triggers that catch retirees off guard, the standard withdrawal order that avoids them, and exactly when to break that order. These numbers come straight from the IRS and CMS for 2026. Most retirees have 3 buckets: taxable brokerage accounts, tax deferred accounts like traditional IRAs and 401ks, and tax-free Roth accounts. The standard order is taxable first, tax deferred second, Roth last. But the real reason that order exists is 3 specific tax triggers. And once you see them, the order makes a lot more sense. Trigger 1, the Social Security tax torpedo. Depending on your combined income, that's your regular income, plus half your Social Security benefit, up to 85% of your Social Security can become taxable. For married couples filing jointly, benefits stay tax-free under $32,000 of combined income. Between $32,000 and $44,000, up to 50% becomes taxable. Above $44,000, up to 85% becomes taxable. These thresholds haven't moved since 1984, so more retirees cross them every year, even with modest income. Trigger 2, Medicare IRMAA, the income-related surcharge on Part B and Part D. For 2026, if your income from 2 years earlier, so your 2024 tax return, was over $109,000 as a single filer or $218,000 married filing jointly, your monthly Part B premium jumps from the standard $202.90 to as much as $689.90. This is a cliff, not a slope. $1 over the line and you pay the full surcharge for the entire tier. Trigger 3, required minimum distributions, starting at age 73 or 75, depending on your birth year. The IRS forces withdrawals from traditional IRS and 401ks, whether you need the money or not. Every dollar of that forced withdrawal counts as ordinary income, which can trip the Social Security tax torpedo and IRMAA in the same year. Let's run the numbers for a couple. Both 67 with $500,000 in a taxable brokerage account, $700,000 in traditional retirement accounts, and $300,000 in Roth. They haven't claimed Social Security yet and need $90,000 a year to live on. Right now, before Social Security starts, their taxable income is naturally low. This is their best window to act. Instead of spending only from the taxable account, a planner would likely have them also pull some money from the traditional IRA each year, filling up space in the 12% bracket, which tops out at $100,800 in ordinary income for a married couple in 2026. Even though they don't need the extra cash that shrinks the traditional account now while they're in a low bracket, instead of leaving it to grow into a bigger forced withdrawal later. Once Social Security start, the math flips. Now, a fixed income is covering part of their needs, and every extra IRA dollar they pull risks pushing more of that Social Security into taxable territory, or brushing up against the IRMAA line, timeline. So the order shift. RMDs get taken first once they begin, since that's non-negotiable. Then the gap gets filled from taxable, and the Roth becomes the last resort, used only for the withdrawal that would otherwise cross a tax bracket or an IRMAA threshold. This order isn't universal. If you're already in a high tax bracket, adding extra IRA withdrawals on top makes things worse, not better. If most of your savings are in a taxable account with very little in tax deferred, you may need to draw from the IRA sooner just to cover expenses. And the IRMAA look back cut both ways. A large withdrawal or Roth conversion this year won't hit your Medicare premium until 2 years from now, which means a bad decision today can quietly surprise you later. If you've retired but haven't started Social Security or RMDs yet, that gap is your best planning window. Pull your last 2 tax returns and figure out how much room you have left in your current bracket before the next one starts. Most people can go right up to the top of the 12% bracket without much cost. Second, before doing any Roth conversion or larger than usual IRA withdrawal, check what your income will look like 2 years from now, since that's the number Medicare will actually use against you. If you want me to run this same breakdown for someone who's already collecting Social Security and taking RMDs, let me know in the comment, and I'll build that scenario next.